Welcome back to Real Estate Economics weekly webinar series covering this particular week the Fresno area. In our previous section we presented data for this particular market showing the transition from healthy market conditions in May 2006 through the current conditions in 2010. Here in part 2 we'll go through that information and those trends in a little different way to put a slightly different perspective to what's taken place in this particular market. As you can see in this particular bar graph, we've got prices shown for May over May from 2006 to 2010 beginning in 06, identical to the previous map series in part 1. As you can see, in May 2006, when the market was relatively healthy, we had peak prices of about $188 per foot on average and a peak average sales price in the data series of about $319,456. By the time we come forward one full year, we've already experienced about a 10% decrease in average value ratio and not quite that large of decrease in average base price, but the market is really just beginning to experience the full distress that takes place. By May 2008, we've started to experience quite a bit of early economic warning signs, if you will. We haven't had the credit crisis and the collapse of Lehman Brothers, this sort of thing, but we're already seeing considerable dislocation from the subprime market. Only certain units are coming for sale. Many people are not recognizing the magnitude of the distress at this point in time, and the numbers have gotten quite low. It's early foreclosure sales that start to drive these numbers down into in May 2008. By May 2009, we have experienced the full credit crisis. All that the early stimulus and the stock market rundown, so we've had just really incredible degradation in values at this particular point. Now, from month to month, there's obviously quite a bit of difference in the data series here. We haven't necessarily gone from $188 per square foot that you see in May 2006 down to less than $88 in May 2009. There are always issues related to that in terms of what's in the data. Who are we losing? Are we losing the early subprime people, and the later purchasers of homes in this market haven't hit the wall yet, that sort of thing. So there's always timing issues. We have seen unit sizes change a little bit from year to year as different parts of the market are impacted, but most of the late arrivals to the market paying the top prices aren't yet defaulting in May 2009. Then we start to see a little bit of uptick in the market. Many people don't experience this, and it's highly localized, but what we see is a little bit of plateauing in the values as many rental investors have come into the market and started to pick up homes. At these low prices, $171,000, rents, many rents in this particular market area will cash flow a good property, and rental investors are culling over the inventory through this area, looking for the right home that they can rent for a few years and then put back on the market as a resale. Here we can examine, not too differently than our maps from the earlier section, how the transactions distribute for the different types of sales. Blue again is resales, green new home builder sales, red foreclosures, and the burgundy purple foreclosure sales. As we mentioned in the last section with the maps, the conventional resales plummeted as the market distress increases, but now has started to rebound because that category includes short sales. As you can see from year to year in the green bars, the new home builder sales have dropped quite a bit with a tiny rebound here, a little bit of a rebound in May 2010. And you can see the foreclosures shown in the vivid red really rise quickly into 2008 before tailing off somewhat into 09 and 010. We think at this point in time, most of the market's been exposed to loan modifications and the government's HAMP process, so we think that's gradually winding down. People with no capacity to pay haven't been able to achieve a modification, and unless the government takes some other action, the market's going to be standing on its own here soon, and really the true effects of what's taken place in the last few years will iron itself out in the marketplace, and we'll have a little better handle on what the conditions are. This is the distribution of sales. This covers only 3 years, just really for readability purposes. If you look at the under 100 category, 2 years ago there was virtually no activity. That would have been May 2008, before the market disruption really hit in its full force. 2009 shows a huge increase in the under 100,000. So we have a really wholesale migration out of what might be considered the middle and upper price ranges down into the most affordable price ranges. Here, those small homes, many of them are good rentals, are being met by rental investors making all cash deals. A lot of multiple offers on good properties, and many of these people shopping for these foreclosures are experienced rental investors, and are really going through the market looking for the best homes with the best schools, with the best market, with an eye towards eventual resale value. Let's go into our 5-year forecasts. This particular slide covers building permits. As you can see, building permits in 2009 and 2010 have plummeted to the lowest point, going back to the beginning of the data series in 1990. During this time, from 1990 to about 2002, this area had a pretty vibrant economy, and so the number of employed persons was growing quite rapidly. Current permits are nowhere near enough to keep up with that growth, so we've got a little bit of a reversal in terms of we are not building the type of units that many of the demographic patterns would suggest we are needed. Employment remains weak, and we'll get to that momentarily. Here's our current non-farm payroll going back to 1990. If you look at the 2010 number, 281,875 total non-farm, that's just about the same as 2002. Unfortunately, this is a pattern we see in many parts of the state and in many of the weaker markets regionally, where the job gains that we experienced in the middle and later parts of the last decade have evaporated, and we are just about back to 2002 employment, with kind of a sluggish employment outlook looking forward. Here's our year-over-year labor force change. As you can see, this market had many good years in the 90s and the 2000s, early 2000s, gaining more than 10,000 jobs annually, and it's really gone stagnant from about 2003, where we're up, maybe 8 or 10 at most, down 4 or 5 or 6, and so there's really has not been that much net growth in this particular market area. We think some of it's migrating outside the area. Clovis has pulled a fair amount, but this would include the entire MSA. Just has not really picked up the type of employment support that we would hope to see, and that leads to a relatively decent balance between homes and employment. That's the end of part 2, so please view all 4 parts of our webinar today.